G'day and welcome to Lunch Money, where workout, special situations and commercial finance specialists talk about the news of the week. My name is Nick Samios. I'm the Director and Fund Manager here at Hermes Capital, and I'm your host. So once again, welcome. Just a little reminder, if you're watching on YouTube, subscribe. And we're also available as a podcast on Apple, Google, and Stitcher. So subscribe there as well, and don't forget to like and share with your friends. Every week we get a mix of professionals from different walks of life to give us their unique angles on what's been going on in the world. And this week our first guest is entrepreneurial accountant David Kenney. David's a partner at Hall Chadwick, has been for 20 plus years. And he's got special interests in startups and business growth. So welcome, David.
Thanks, Nick. Thanks for having us.
What has been keeping you busy this week or these past couple of weeks?
Oh, look, it's been the sublime to the ridiculous, from capital raising for companies. Got a couple of businesses that are selling for very healthy numbers, and then keeping doors open and sort of managing for different companies, effectively like their outsourced CFO. Through to companies still queuing up to go to the US and jumping in the immigration queues in the US to start businesses in the US. As I said, capital raisings at one call and then job keepers another. So it's been a pretty topsy-turvy 8 weeks, but the last 2 weeks is starting to settle down a little bit, to be honest. So it's been good to see some people are getting back in control of what they're trying to work out.
So so there is light at the end of the tunnel. You're obviously seeing a lot of activity by the sounds of things.
Yeah, look, it's all sector specific, I think, because some companies that are doing really well are in financial services areas and food and just crazy things. Like I was talking to a client yesterday about even a potential IPO, and they're in the travel sector. So right. Companies that aren't necessarily impacted by travel per se, because they can reinvent to just mainly focus on domestic travel versus flights, etc. So that's been really just reinventing businesses and working out how they react and come out of the crisis or slingshot out of the crisis a little bit better than they were before, and recalibrating their balance sheets and their cash flow burns and working out whether or not they're eligible for this and that benefit, and working out whether or not they're going to put on more staff and attack when a lot of people are probably stepping back and seeing AdWords coming in at crazily ridiculously cheap prices because people are out of the market. So there's a lot of people that are sitting back hibernating, but I think the better people are still swinging away and trying to reinvent and create opportunities for them and help them out and give them a bit of a head start while everyone else is sitting on the bench.
Well, yeah, look, it has been crazy. I mean, it's been interesting, for example, to follow Webjet. It's if you've been watching, you've probably been watching that share price, given your interest in travel. I mean, what's behind that, do you think? Is it just because it went so low?
Yeah, I think it's people are. Market builds in expectations of what the price is going to do and what the business is going to do, and I think we've seen globally, a lot of countries, spend their way out of recession, and so I think that the expectation is that the recovery, certainly in Australia, is going to happen faster. So we've got more optimism in domestic travel, and people, that pent up demand is also starting to show. So there's a lot of there's been some good things that the government's done to try and stop the severity of the landing, but also just because we're on this big island, it might well be a better position than most. So
we chose well, didn't we?
We chose well,
Australia. That's for sure. Look, I mean, there's 101 questions I'd love to ask you about the appetite for capital and all that sort of stuff. But first, we'll just go to. I'll just put you on hold there, David, and we'll go to our next guest, Daren Anderson. Daren is a managing director at ERA Legal. You may have seen Daren in one of our earlier episodes. What's been keeping you busy these last couple of weeks, Daren?
Well, on a positive note, Nick, from the start of the pandemic, we saw immediate and almost total cessation of our lending work, the work we do for a number of private lenders, sort of dried up completely. We probably would have seen over the last 3 months, we probably would have written somewhere between 150 to $250 million worth of loans. We've probably written about 40 during that period, but I've noticed it started to pick up over the last 3 or 4 weeks, which is good. From almost total cessation, the lenders are back out lending again, which is a good thing. There's certainly a lot of recovery work, a lot of default work. I think we're going to talk about that a bit later on.
I wonder whatever happened to when all of this started, and I think probably when we spoke all those weeks back, everyone was talking about the holding docker. What happened to this plethora of holding dockers? I think you were a little bit sceptical at the time.
Well, I think the government gave the whole country a holding docker. The Scott Morrison gave the whole country a free holding docker, to the chagrin of a number of insolvency lawyers and insolvency practitioners, by giving a 6-month moratorium against any director-related insolvent trading claims, and also essentially telling everybody they didn't have to pay their debts for 6 months by changing the 3-week period on statutory demands to a period of 6 months. So essentially, your payment terms were extended by the government by 6 months.
And you're saying that you're seeing a little bit of lending activity come back. I can say that, in my personal experience, people are still reluctant to make commitments because there's still a certain level of uncertainty. Do you think that's changing?
Well, I'll put it this way. I think that you could put 100 million or 100 billion out the door tomorrow if you were if you're a silly lender with plenty of capital. So it's not because the lenders don't have an appetite to lend. It's because the lenders are sensible and just sitting back and taking a breath and waiting and picking the right deals. So certainly for a lender, there's plenty of deals out there. But if you want to be a sensible lender, pick the right ones.
Yeah, I think that certainly it's a question of sticking to your knitting. We've certainly seen plenty of what you might call opportunities that are weird and wonderful, but certainly nowhere sort of necessarily down the centre of what our mandate or bailiwick is. And so, do you think that the lenders you're dealing with, are the deals beginning to happen because they're just running out of time, or because the shackles are coming off?
I think the deals are happening because the lenders are more comfortable with how the market is playing out. The loans are stacking up. They can see there's a bit of the fog is starting to clear about what might happen in the future.
I've just got a question actually, Daren. I haven't seen this before. We're just using a little bit of technology, but one of our viewers is asking, are they distress lends, or I guess because you're in the private, a lot of your borrowers, a lot of your lenders are private. Well,
in terms of distress lends, I see that the question's come from an insolvency practitioner. Not distress lends in terms of the borrowers being in some sort of insolvency position or wanting to take out a lender who's about to pull the trigger on them, but essentially borrowers who can't get the money off the first tier banks.
Okay. All right. Well, look, I'll tell you what. That's a bit of a good segue for our next guest, Daren. Justin Doobov. Justin Doobov is the managing director of Intelligent Finance. How are you, Justin?
Good, thank you. Thank you for having me, Nick.
Fantastic to have you along. Now, I know, Justin, that you obviously deal with some private lenders, but you also deal with a lot of the major banks. So, just hearing what Daren had to say then about activity, what are you seeing, and what's keeping you busy?
2 months ago, what was keeping me busy? We had a lot of clients. We've got thousands of clients, but we had several hundred of those clients contact us to put payments on hold and clients that had previously weathered the storm of the GFC. We didn't have one client go into default during the GFC. So it was a bit of an eye-opener to have a lot of clients early on. As soon as COVID hit, people were losing jobs, people were, their revenue stopped overnight. And so we were fielding a lot of calls and just helping clients and guiding them through the path of which path to take if they didn't have the revenue to pay their loan repayments. This was pre the banks coming out with we'll put your loan repayments on hold for 6 months. And so I was navigating that. And then we thought that for 3 to 6 months we'd be dead, we'd be, twiddling our thumbs and fingers. But we have never been this busy, just non-stop with clients that, whether they're very optimistic, that'll tell in the future, but we're inundated with people wanting to refinance to better loans, better structures, but also a lot of people wanting to purchase. And there's a lot of demand, even during COVID when people couldn't even actually go to an inspection. We had people buying properties just because whether they're a buyer's agent or their real estate agent had gone through with their mobile phone and showed them through the property, and they were happy to exchange on that.
I must say, I've been following Chris Joy, who writes for the AFR, and he's been having a bit of fun with the property bears. I mean, I'm not sure if I describe him as a bull, but he's certainly not a bear, and he's done a lot of research showing that the property market's doing okay. I'm not sure if you follow him. I just wonder. I've been speaking to some equipment finance brokers lately, and they're saying that if they're taking a deal to one of the major banks, for example, that major bank is requiring the borrower to sign to say whether or not they've asked for a payment holiday or a hiatus, a 6-month reprieve from other banks, and that's basically precluding them. Are you coming across any of that?
Yeah, lenders are, like in the past, if you were self-employed, they would look at your last 2 years' tax returns and your 2 years' income. So, like today, we're in June, and historically, if we did a loan for someone in June, they would look at somebody's 2018 and 2019 tax returns, which are kind of irrelevant in a growth market, where now they're actually asking, show us your last 2 weeks, or when I say the last 6 months, business statements, but also show us the last 2 and 4 weeks of your business accounts and loan statements, credit card statements. Show us all of that, because they want to see where was your income going like that, and then all of a sudden it's fallen off a cliff. And then some lenders are wanting to know, have you taken on JobKeeper? If you have, why? And that you need a good explanation as to why somebody's taken on JobKeeper, and give an explanation as to why it shouldn't affect their income going forward. So, but it does, not to side with the lenders, but if someone has put their payments on hold, it does show a weakness somewhere in their financial position. So we've said to clients that if you've got cash to trade out of any issue, because you're not getting a free kick. It's not your payments are cancelled. It's just deferred. So if you've got 100 grand in the bank, why would you put your $1,000 a month car loan repayments or truck loan repayments on hold? You may as well pay them, and it shows it shows strength and doesn't show any weaknesses in your financials. Because especially that a lot of companies are expecting to trade out of this quite comfortably. So put your payment on hold and don't just try and take the free kick. And some people made that mistake because as soon as it was announced, they just put it on hold when they actually didn't need to.
Well, I had one broker telling me that with one of the banks, when they first brought in this ability to extend payments for 6 months, they were inundated for 2 weeks because they had no systems for coping with this.
Yeah.
But then as soon as people realised that it was beginning to affect their credit with the banks, the next 2 weeks, people were ringing madly saying, no, please put me back on my regular monthly payments. I guess you handle that sort of stuff?
Yeah, absolutely. And we actually sent an email out to all our clients when it first came out saying, before you do it, these are the potential issues that you could face. And one of them being it's not going to directly affect your credit report, but it's going to affect your credit standing when a lender looks at your bank statements and see that you stopped making those payments, but they can see that you should have made them.
Now that we've introduced everybody, we will take the next step. We'll just bring everybody together to begin with. I guess Justin made some interesting points there, David. You seeing any of that sort of thing? Are you dealing with lenders at all?
Yeah, definitely. I think there's been a rush to try and put things on hold, but demonstrating strength and having a look at your balance sheet and sort of triaging creditors and making sure that you make sensible capital decisions rather than panicking. That's been the key thing, and people are just wanting to know what to do, how to manage that timing and cash flows, and working out, are we going to get JobKeeper? There's a lot of different moving parts. So whenever there's a crisis, I find that a lot of the times the CFO becomes the CEO, because you're sort of managing capital allocation decisions, which are pretty critical. And so that's just been the last 8 weeks with conversations about cash flows and dealing with lenders and negotiating with landlord extensions or not. And working out, what's your new business look like after that? After this, are you in a category that's a winner or a loser? And how do you come through that?
Okay, now, all right, well, exactly, very interesting. I just imagine that a lot of lenders would be asking you for your opinions on financials as well. Look, we'll go to our news headlines, because we've got a few to get through. We put 3 different headlines together here. ANZ. This was on Monday. ANZ, one of the ANZ bankers was suggesting that businesses, if they're struggling, they should just wind up and walk away. And I think, Daren, you'll remember when we had Scott Langdon on, he made the interesting comment about businesses. It's an opportunity to what did he say? Elegantly dismount was one of the things that he'd said. But so we've got the banks on one hand saying, look, wind it up and walk away if there's no future for your business, rather than seek all of this support. We've got bankers that are more optimistic on their problem loans on one hand, but on the other hand, there's this headline: loan arrears increase with economic downturn. For someone like me who's trying to forecast the future, there's very mixed signals there. What do you make of all of that, Daren?
Well, which headline do you follow, I suppose? Getting back to the elegant dismount, I'm a big fan of the elegant dismount. Unfortunately, we're not seeing enough of it. I think this is it's a perfect opportunity for businesses that are in distress to get out with some capital intact. And when I read that article about what the ANZ had said, I thought Scott might have ghostwritten it, because that's what he was talking about 8 weeks ago.
Yeah.
In relation to the headline that was in the AFR about the bankers being more optimistic, I think the problem with that article is that the anticipation was wrong. People seem to anticipate that everything was going to fall over and collapse within a short 3-month period. I think the reality is things are going to be okay up until about Christmas time or thereabouts, except if you're in hospitality or you're in tourism, which is a disaster. The real problems are going to start to flow through, I think, next year. Next year, when the focus is off the banks, people have forgotten about, we're all in this together. We've got to work collectively and be nice to each other. When the banks and the lenders start to crack down, or the first-tier banks start to crack down on their banking covenants, people are without a job. All the businesses who have been shut down and have reopened realise they can't survive. That's when things are going to really get ugly, and I think you're going to see a catastrophic number of mortgage defaults, both residential and commercial, and that'll flow through from about the end of the first quarter next year through into 2022. So I think we're in for a long, hard road.
So you're really saying that this sort of, I guess, no man's land, or whatever you want to call it, that we're kind of in at the moment. You're seeing an extension of that, which there's not going to be a correction as such in the short term, is what you're saying. What do you think, David? I mean, let me just interject by saying, I've been speaking to a bunch of people through the week who tell me that the banks are doubling their capacity in their workout teams, and the banks themselves are expecting trouble from September onward. People are talking about a cliff. I know, David, you're sort of, I'm not sure what part of the building you're sitting in, but I know you're not sitting in the same part as your insolvency guys. So you've sort of got a more optimistic view, presumably.
Well, I think that at a macro level, what Daren's saying is right. There's going to be some headwinds that we're going into, but it's dangerous to rely on a general statement to say, look, wind it up and walk away, because a lot of companies that I'm working with really are reinventing, and they're coming out of this stronger because they're being able to really look at how they're allocating their capital and who they're hiring, and reviewing their teams and working out where their customers are going and how they can support them, and they're going to come out of this stronger. So obviously it's a good opportunity if your balance sheet is weak and you've got no reasonable way of changing up what you're serving up to customers, and your unit economics don't make any sense anymore, then definitely it's probably worthwhile considering walking away and sort of no longer being liable or being potentially personally liable. And in this amnesty, I guess we have an opportunity to look at that, where there's a little bit of all bets are off in terms of insolvent trading. But I think that there's no doubt that there's going to be some companies that are going to fall over much more after this 30 September goes through, because everyone's sort of sitting on their hands waiting to see, what do I do? And banks aren't appointing, and all of those things are making it a sort of a false sense of security. But equally, well, there's going to be some people come out of this stronger. I mean, some of the best companies, or the best company on the ASX by market cap, CSL came out of a crisis, and so I don't think it's not a one-stop shop. For the message is walk away. I think we've got lots of good companies out there doing quite well in this environment.
Well, yeah, I mean, I guess there's M&A opportunities and all sorts of things. Just before we move to the next headline, Justin, anything you'd like to add?
Yeah, I think from what we've seen, that over the past 10 years, especially when as all these businesses have been ramping up and wanting to borrow money, there have been a lot of companies that don't have the basic fundamentals that that you're in business to make profit. There are a lot of businesses just in it to build a customer base and try and sell their business, and a lot of those companies we're seeing are struggling because they didn't have any decent revenue or decent profit coming in the door to keep them alive. So it's kind of the COVID has basically expedited their demise. So things like throwing money at them for JobKeeper and all these incentives is putting someone on life support that probably should have not been there in the first place.
Right.
And then one of the other things was where the government just blanketly said, and the banks followed by allowing everyone to put their loans on hold for 6 months. We had pushed, and only recently have they allowed this, but we were saying, don't literally go from someone paying a high monthly payment to paying nothing. Have an option in between where if you force people to pay principal and interest, so they're on a principal and interest repayment, why not get them to pay interest only? So instead of making them pay nothing, get them to pay something, so at least they're staying on top of their debt and they're used to paying a monthly repayment. Because now you're basically taking somebody that's for the next 6 months has got no monthly loan repayments. They'll allocate that spending somewhere else, and then all of a sudden in 6 months' time, you're going to ask them to now start paying a higher payment. So I think they need to stagger how people come off this payment on hold life support system. So things like now the banks have started, and we've been pushing it for 3 months now, or 2.5 months, to say allow people to pay interest only, but don't make it just for 6 months. Make it for 12 months. So so that when people are coming off, you've got people slowly coming off at staggered points. Especially that if some people can't afford to make their loan repayments after 6 months and they have to sell, you don't want a glut of properties hitting the market, and that'll put a downward pressure on the market.
Yeah, I can't believe, I know that everyone's talking about a cliff in September, October. Daren's suggesting it's going to be sometime next year, but I can't believe they're not going to maybe extend JobKeeper, or the banks. The banks will also be working on. The banks will be cognizant of all those things that you've just said, Justin. So unless everybody takes the view that they just want to, rip the Band-Aid off, we'll see. Listen, we'll go to the next slide. We're just there's a couple of slides we really want to get to, so we're just going to skip to this one now. Virgin's obviously a big topic. There's a lot been in the news this week because there's been a bit of argy-bargy with different buyers. There was 2, and then there was a third one, and then there was a fourth one. What's your take on the Virgin situation, Daren?
A extraordinarily fast sale campaign, and as you say, there's 2 bidders left, and I'm almost positive that a couple of the bidders that have been excluded are going to be very unhappy about the process and how it has been run, particularly BGH. And I wouldn't be surprised if some litigation falls out of it.
Is that right?
In the next couple of weeks. It'd be interesting to see.
Wow.
I understand the final bids are for the two remaining are due in around about the 22nd of June or thereabouts. And the Bain Capital guys, I think, in my view, probably got the inside running. They certainly have the experience.
Which one's the one that Richard Branson's involved with?
I think, well, sure if it's, is it Bain, David? Do you know?
I'm not sure, actually. I mean, I haven't really been following it closely other than just wondering about, my understanding is that the Queensland government's going to just go in with whoever wins, but I haven't followed it intimately.
I know that the Bain guys have got our Elegant Dismount friend Scott Langdon and Cordamentha in there advising them, which is a pretty smart move given their recapitalisation and turnaround strategy. So be interesting to see what happens over the next couple of weeks.
And David, you're sort of our resident M&A expert on this panel. I mean, I know that you're saying you haven't watched it closely, but Daren's made the comment that he thinks the sale process has been very quick. I mean, what's your view on that sort of thing?
Yeah, I mean, something this complicated is it has gone quickly. People are wanting certainty, but typically something like this is a very planned, sale. But in the context of an insolvent issue, there's obviously statutory rules that are driving the timetable. But yeah, look, it's definitely going very. It's been surprising how it's operated in terms of disclosures and look, there's a lot of stuff going on behind the scenes, no doubt. It's just one that I haven't been following closely, but just I know some of the people involved in the bid, just in one group, but I don't know the details. But it definitely has. I agree with Dan. It seems to be going pretty quickly for a business this complicated, but who knows?
Yeah, I guess I'm a virgin frequent flyer, so that's kind of the extent of my interest at the moment. I just hope that they're still there and all my points are intact. There was an article yesterday. I mean, through the week, I'm obviously seeing these articles and thinking, geez, that'll make an interesting talking point. And there was the ATO to investigate $11 million JobKeeper claim. And then today we've got the cops raid firm over JobKeeper wrought. I'm just reading the headlines there. I'm not making any accusations, but it was a betting company in Victoria.
Yeah.
I don't know the background here, but Daren, what have you been following this one at all, or do you think there'll be more of this?
I think, unfortunately, there'll be a lot of it, and I think anyone who's wrought in the JobKeeper scheme, it's a disgrace because it's so easy to rort, and the government and the authority should come down on them like a ton of bricks. It's just like cheating on your BAS or cheating on your social security. Yeah, people.
It seems to be awfully quick that they've swooped in on this.
Well, one would imagine that someone from inside that business has tipped off the authorities. One would think that the government would want to get the message out there very quickly that if you're rorting the JobKeeper scheme, we're going to come down on you like a ton of bricks. Because, as I say, it's extraordinarily easy to rort, and I think there'll be a hell of a lot of it going on, unfortunately.
Yeah, I think it's a positive message too, Nick, to get it out quickly to say, it's there for people that need it, and if you're not entitled or you artificially contrive, your turnover figures, which is I think what they were. The AFR was saying there was some internal emails. I have read that article, and I think it's a good message that the ATO are getting on the front foot to say, be aware that it's not free money. There are very stringent criteria. But interestingly, I think that a lot of people haven't claimed JobKeeper because one of the statements was that it's incredibly complicated because it's been the legislation that's been done by press releases and Treasury announcements and changes and new formulas. So it has been a pretty stringent thing that's been applied. But, yeah, there's going to be a lot of I'm sure Darren's right. There'll be a lot of people claiming it that aren't entitled to it. So that's going to keep the ATO busy for a long time, I'd say.
Can I just add this quickly, Nick, as well? It's not only the JobKeeper that's being rorted, but it's the commercial landlords who are also getting rorted under the code by tenants who do not fulfil the criteria but are claiming to fall within the code as well. So it needs to stop.
Listen, I've just had a couple of our viewers have told us that it's the Cyrus bid is the one that Richard Branson's involved with. They want to bring the fun of they want to bring back the fun of Virgin Blue. So happy days to them if that happens. Well, so that's that. I'll just give you my mercenary thought when I saw that. I thought, gee, I wonder, there might be some lending opportunities there for people that need to write big fat checks back to the ATO. There might be something in that for Justin and myself when that happens. And so we'll go to if we can go to the slide about the $1 billion stimulus injection. Here we go. And I'll ask you to comment on this one first, Justin. So this is where the government's announced a $1 billion boost for builders to kick off a stimulus. Firstly, what I guess, Justin, what do you think it'll mean for the property market? And are the banks ready to support this activity? People presumably aren't going to be doing all this building activity out of their piggy banks. Presumably they'll need bank support. What do you think?
Well, I think they've made JobKeeper so easy to claim, and they've made this one so hard to claim. It's so technical with how you've got to earn below a certain income, you've got to spend a certain amount, but not too much. There's too many restrictions, and they're trying to get people to spend. You've got to spend $150,000 to get your $25,000 back. But for most people, and then you only can spend it if you've got a property on an existing property that's valued at less than 1.5 mil or a new build of less than $750,000. But people don't make those sort of decisions to spend $150,000 to $750,000 worth of building costs overnight. So it's going to take 3 or 4 months for someone to decide what they want to do. They've got to go get council-approved plans if they're spending, if they're renovating a house. So I think my personal opinion is, instead of making on a investment that might take 3 or 4 months before a tradesman actually will even need to be engaged, because if someone engages a tradesman tomorrow, it's because they were just about to sign a building contract, because you have to sign a building contract to be able to get it. So I think that it probably would have been better delivered and more people could have used it if it was more about renovations. So any renovation over 10 or 20 grand, whatever it might be, you want to install a new deck, paint the house, put new tiles in the bathroom, and
put a cabana on your swimming pool out the back.
Put a cabana out the back of your swimming pool.
What about some pink bats?
A pink bat. But each of those. Because my concern is that people are going to rush. They'll end up, someone that wasn't going to renovate ends up deciding to renovate. They'll sign up with a builder. They'll probably pay a premium of more than $25,000 to lock in a builder, and someone will stitch them up, and they'll be doing it for the wrong reason. Where there's a lot of people that could have just done small renovations, and they could have engaged the tradie today, tomorrow, on the weekend to start painting the walls or putting new decking down in the backyard. And that would have had a broader benefit for the economy and kickstart the tradies working straight away.
And we've already got a very high debt rate anyway. I mean, Australia's property love of homes. I mean, you've got to have an income of less than $125,000 and spend more than $150,000. That just means they're encouraging people to get into more debt. Maybe good, I guess, Justin, but at some point, we're very long on property. And the way out of this is creating jobs, and obviously the construction industry is great, and that will help lead things. But we've gone back to either the mining or the houses. We need to really encourage people in other businesses and be the smart country rather than just relying on homes and dirt.
Well, the other thing also,
I was going to say another time, David. We'll have to get you back to talk about what that might look like in terms of manufacturing and other sectors that you're involved in. As you're saying,
my concern is that people are going to rush. They'll end up, someone that wasn't going to renovate ends up deciding to renovate. They'll sign up with a builder. They'll probably pay a premium of more than $25,000 to lock in a builder, and someone will stitch them up, and they'll be doing it for the wrong reason. Where there's a lot of people that could have just done small renovations, and they could have engaged the tradie today, tomorrow, on the weekend to start painting the walls or putting new decking down in the backyard, and that would have had a broader benefit for the economy and kickstart the tradies working straight away.
And we've already got a very high debt rate anyway. I mean, Australia's property love of homes. I mean, you've got to have an income of less than $125,000 and spend more than $150,000. That just means they're encouraging people to get into more debt. Maybe good, I guess, Justin, but at some point, we're very long on property, and the way out of this is creating jobs, and obviously the construction industry is great, and that will help lead things. But we've gone back to either the mining or the houses. We need to really encourage people in other businesses and be the smart country rather than just relying on homes and dirt.
Well, the other thing
I was going to say another time, David. We'll have to get you back to talk about what that might look like in terms of manufacturing and other sectors that you're involved in. As you're saying, it's not just mining and dirt. What are your thoughts, Daren? I sense a modicum of scepticism.
My concern is this. I think we went through a 10, 12-week period where we had no cynicism in politics, where everyone had banded together. I think this statement about the building stimulus is really, the cynical politics is starting to come back. It's really, let's put out a press release, pretend we're doing a stimulus, but really no one's going to qualify for it. So let's get back to what we were doing a couple of weeks ago, which was working together, and hopefully the cynical marketing politics isn't creeping back. That's what I fear.
Yeah.
And also,
it's starting to happen.
To follow on for that as well, it's geared towards owner-occupiers. So as what David said, you're pushing people into more debt, which while we make money from people going into debt, I'm not a fan of people getting into too much debt and getting into the wrong sort of debt. But you're pushing people into getting owner-occupied debt that's non-deductible, where if the whole idea was to stimulate the economy, then why not have it for investment properties as well? So at least if somebody's getting into debt, they're then improving the investment property that's going to get a higher rental return and generate money for the person, as opposed to giving them bad debt of an extra $150,000 to $750,000.
Yeah, geez, it does. It does certainly have the potential for biting back, doesn't it? We're just running out of time, so just maybe some closing thoughts on how do you see the rest of the next couple of weeks playing out? I'll start with you, David. Are you seeing many? I know there's this 100% deductible investment allowance. I mean, what do you think is going to keep you busy the next couple of weeks, so as we see out the financial year?
Oh, look, it's just more of the same, honestly, Nick. I think there's people still out there capital raising. I've got an IPO possibly starting. I think there's a lot of people that are reinventing their businesses, and working with some retailers for that purpose. I think there's a lot of misconceptions about people buying cars, whether or not where you can go out and buy luxury cars. I've been asked a lot of questions about, can I go get a luxury car? Obviously, There's a lot of consumer sentiment issues. It's all over the place at the moment. I hope that we're spending more time dealing with helping Australian companies and government to buy from Australian companies. And that's what's going to drive us out of the market, rather than buying foreign product and foreign American software, and starting to see the Australian government look after Australian companies and buying local. I think that's hopefully going to keep us. That'll do the best job of everything in terms of getting us out of this mess. To the extent it is a mess too. It is minus 0.3%. The start of the report.
That's just that quarter. All right. Well, just briefly, Justin, what do you think's how are you going to see out the rest of the financial year?
Well, I think from our side, it's going to keep growing. Like even during COVID, we were busy. I think it's just going to keep getting busier. Australians have got a massive appetite for property. It's seen as a safer bet for parking their money. We've got a lot of clients that have got a lot of cash in the bank at earning 0.1%, like bugger all. You put it into an investment property, you're going to get 3. Assume your tenant pays, but you get say 2, 3, 4% rental return and potentially capital growth. So I just see that market still growing.
Very tough for retirees, isn't it? Daren, what about yourself? How do you see yourself playing out the rest of the financial year?
Well, what I'm looking forward to, Nick, is the Queensland Premier letting us back into Queensland so we can all go on our winter holidays and spend some money in the country. So I think it needs to be a bit of sense with that, but really more of the same, Nick. I can't see anything changing over the next couple of weeks, but hopefully we can get some of the borders reopened so we can start generating some income for the poor hospitality workers and the tourism operators that are suffering the most. And can I just say, make a plug? The restaurants are reopened. Get out, if you've got money, get out and spend some money in the restaurants and bars and help the people out who really need it.
Absolutely, that's a great point. All right, well, look, on that, we'll wrap up. So many thanks to Justin Doobov from Intelligent Finance, to David Kenney from Hall Chadwick, and Daren Anderson from ERA Legal. Thank you very much to those of you that have watched us live. Shout out to those of you who are watching us on replay on YouTube over the weekend, or who've downloaded the podcast. Thank you very much, and we look forward to your feedback. So we'll leave it there. So thank you very much, everybody.
Thanks, Nick.
Thanks, Nick.
Thanks, Nick.
Cheers.